Hi.
How are you?
Good. How are you?
I'm good. Just put my dog away. I'm hoping he doesn't bark a bunch.
No problem.
So
Are y'all back in the office or are y'all working from home still?
at home. So this is the home office. So yeah.
Gotcha.
It's been working okay though. I actually like being at home more. Mary, can you hear us? Oh, I guess she's not there yet. So that's my sister, Mary.
Okay.
And her
All
and my brother-in-law, they own a insurance agency that kind of covers all the personal side, like what I was telling you about. So
Yeah. Cool. No problem there.
I need to be watching the waiting room, I think. So we had we did have a webinar where it was hacked even with a password. And so if something crazy like that happens, we will be just shutting it down immediately.
Sure.
So let's just hope that doesn't happen again, because that was
I
kind of
understand.
crazy.
I've been reading all sorts of fun things that have been happening because of Zoom and everything else. And then not only that, now with school and what's going on with colleges and Zooms and kids at home and Zoom and, just.
Yeah, there's been a lot with kids at home and like inappropriate things in other people's homes. And it's, the whole thing's kind of a mess.
Yeah.
Everyone's doing the best they can. Hi, Amanda.
Hi, can you hear me?
I can.
Sorry, you probably heard me say, oh, I need to shut the door. Let me do that.
Great.
We have kids in every room on school, so it's better if I keep the door shut.
Oh, yeah.
Sorry.
All good. So, Amanda, this is Chad. I don't know if you all have met before.
I have not. Hi, Chad. Nice to meet
We
you.
have not. Nice to meet you.
Thank you.
And then my sister Mary's on. So just wanted to make sure everybody's on. We can just kind of be admitting people. We'll probably give it until about 12:02, and then we'll go, because usually people are running, a minute or two late.
Sure.
So yeah. I don't know if you want to double check and see. Chad has some slides, Amanda, so we need to probably make him a co-host so he can
Sure, I can do that.
share on his.
Nope. Can't share my screen.
Yeah, actually.
We shut it down after our fiasco, just so that nobody else could share their screen without our authorization.
I understand. Makes sense.
Shannon, I think you might have to
try to do it.
Yeah, so you just hover over his name and click more.
There we go.
Okay,
all right,
great.
Now try. We'll see if it'll let you share your slide.
Yeah.
Great. Very good.
All right, I'm going to stop sharing at the moment. Let's go back to that. So Amanda, you have kids on Zoom in school. How is that going?
Yes. Yeah, it's going well. We have one that's a freshman in high school at Churchill, one 7th grader at Bradley Middle School, and then a 1st grader at Coker Elementary. Okay. So I think we've been doing it for over a month now. So everybody's in the routine and seems to be able to do it pretty independently. So it's not too much trouble.
Okay.
It's just the 1st grader that needs the most assistance, but
sure.
It's going well.
Mine are all in person, so.
Okay.
Yeah.
Very good. Yeah. We had the option to do that, but we share our house with my mom and dad, who are more than willing to help. And my mom's a retired school teacher, so she's in charge of the 1st grader. So it works out just fine to have them at home. So.
Nice. Yeah.
Yeah.
No, there's definitely some benefits there. We moved, and so we're in Comal now. And
okay.
With that, they had the option, and just because they were new, they wanted to go. They were kind of like, we don't know how long school will even be in session. It was kind of like, yeah.
Yeah.
They chose to go back, so they've been in school for about a month now.
Wonderful. That's great. I'm sure they were happy to see their friends.
Well, it's all new, so they don't. That was kind of a big thing.
Right. They don't have to.
That was kind of one of the big big points for them because they didn't have
Right.
any friends, so they wanted to go meet classmates and stuff like that. So
Yes. Hopefully everybody recognizes each other once masks come out off and things get back to normal.
true, very true.
Yeah.
Yeah, it's seems like most of the people though did send their kids to school, at least initially, for sure. I think the high schools had a lot less just because of athletics.
Yeah.
Because if somebody was to come down, if you did come down and you were in some sort of athletics, the timing in which you could then re-participate was pretty long to get back to school. So I've been hearing that at least many high schoolers have said, well, then I don't want to participate because I want to be able to play football or whatever it might be.
Okay. Got it. Yeah.
That's what I've understood. I don't have any high schoolers at this point in time, but that's what I've understood so far.
Okay. Yeah. Yeah, I think at I have a freshman at Churchill, and I think their football season has started, and it's just they're doing the best they can to keep everybody safe.
Yeah. That's what I guess the UIL rules or something has come back. That's basically if you test positive or I don't know how close proximity, that you're out for not only the 2 weeks, but it's possibly even 4 weeks that you're out.
Wow. Okay.
So obviously from an exposure standpoint, if you can stay home and just show up for practices, which I guess is being allowed, at least out here. Again, I'm not 100% sure what, on there not having kids at the high school. And my daughter's in 6th grade, so she's not in any athletics with the school.
Right.
So,
right.
Yeah. So apparently a lot of people showed up first week or so and then decided, well, it's not worth it
to risk it.
Take the chance. And so they just staying home and doing their work.
Yeah. Got it. Yeah.
Hi everyone. I can see everyone kind of slowly coming in. We'll give another minute or two for people to join. All right. Everyone's turning off their cameras. Don't be shy.
Maybe people are eating lunch and they don't want to.
Yeah, that's what we had a meeting. I don't remember what it was, Amanda, yesterday. It was our training over lunch, and I felt awkward eating like with my camera on. It was weird. Yeah. Hi, Margaret.
Oh, you're on mute, Margaret.
Yeah, I probably will turn my camera off in a minute, not to be rude, but I'm here listening.
Totally understand. We'll go ahead and get started. And I'd like to introduce everybody to my friend, Chad Gilpin, and he is with Alliant Insurance Services out of New Braunfels. And we met Chad through a mutual friend, and we have a lot of similar clients. And so wanted to just have a discussion around insurance. I know a lot of people are noticing that their costs continue to increase every year, and now especially recently they're going up even more. And so wanted just to give Chad a minute to introduce himself, and then we're going to just kind of go over a high-level overview of insurance, and then we'll talk about some strategies, things to look for, ways to potentially reduce your cost or have more of effective coverage, and then we'll go from there. So Chad, you want to introduce yourself?
Sure. Yes. Well, thank you. Appreciate the opportunity to talk with everybody today. So again, Chad Gilpin. I actually was a partner in a firm in New Braunfels called T-Core Management. We just recently sold back at the end of the year last year in 2019 to Alliant. Alliant is the 9th largest broker in the nation. At T-Core, our focus was on total cost of risk with energy and construction clients. That makes up probably 95% of our client base at T-Core. We were purchased because of some of our operations and things that we do, and we joined into Alliant's Specialty Energy and Marine Division. So we actually have about 100 employees in that division across the country, everywhere from Houston, Dallas, to California, Maine, Boston, and upper West Coast as well, or some people basically on the marine side as well. And so we have capabilities now all across the country, the U.S., onshore, offshore, everywhere, to be able to help you, any client within anything within the energy marine space. Also on the construction side, we're the largest construction broker in the nation. So we can help everywhere from startup companies to Fortune 500 stock market company, everything in between with their insurance. A little bit about my background is I've been in the insurance industry, both on the company side, on the carrier side, for about 10 years. And then for the last 7 years as an insurance agent on this side, helping and working with customers there. Again, I run the gamut on there, in the sense of I work a lot with upstream, midstream on the energy side, and then everywhere on the construction side as well with clients. So today I'm going to spend a few minutes. I realize insurance can get a little boring, so I'm going to stay on a very high level of what's going on, kind of talk about what's happening in the marketplace and why you're seeing in your businesses seeing increases. I focus on the property and casualty side of the business. So not on the employee benefits, medical, any of that, or not in the personal lines. My focus is strictly on the property and casualty lines of that. And so we'll talk about what's happening. And in fact, I got an even better, I wish I had it in time to put it into my slideshow, because it's really going to drive home of what's causing it. But I'll talk about a little bit, an email that came out from the Law Journal about the top 100 verdicts in insurance over the last, in the 18 and 19. And this kind of goes into why things are driving the cost so high with that. So I guess it looks like some other people join us, but I'm going to go ahead and start.
Absolutely. Go ahead and start. And one thing I want to mention is, if you have like a specific question about insurance or coverage, if you want to type it in the chat, I'll be monitoring that, and then we will do some just kind of open discussion and questions at the end. So if something comes to mind and you want to type it down there, we'll make sure we address it.
Great. So with that, like I said, kind of topic today, I realize this might be hard to see on the screen, but it kind of gives you, a visual here. I think you're probably seeing, if you're working on it, if you're working on your insurance for your company, you're seeing this across the board as you're talking to whoever you deal with as an agent at this point in time, that rates are going up. And rates aren't going up just in certain lines or only in one line of business. We're really starting to see it where rates are going up across the board. This starts in February of 18, right here on the property side, sorry, there, and goes up. And you can see that the trend is starting to spike towards the second half of last year. You have had some dips, but remember, we're just going through, we've had 3 storms hit the US today. We have wildfires in California. We have probably, I'm sure, because we're still in the middle of it, potentially more hurricanes that could hit. It's been a pretty active season. All of that, even though it may not affect your business directly, does affect what the carriers had, and they have already started seeing shrink and tightening in capacity. As I show here, pricing, again, the trends just kind of show significant professional lines. Again, not only this gets into only professional that you may think, but also into your executive lines, or what I like to call them executive lines. So your directors and officers coverage, your employment practices liability coverage, those things are seeing more and more. And since COVID has hit, we're seeing more and more lawsuits coming out on those types of claims that are out there. And so that piece, again, is tightening across the board. Publicly traded companies and their D&O are getting hit big time because of COVID. We're seeing lots of lawsuits starting to pen. And there are, if you've seen in the ads and papers, depending on where you live, Thomas J. Henry has a bunch of ads out there that they are hiring litigators. The rumor is, I don't know that for it to be true, but the rumor is that they're gearing up to start suing companies based on shutdowns and COVID and trying to help and gain. And so we're going to see a lot of what happened to shareholders, whether that's public or private. If you have shareholders, what did you do management wise? How did you protect your balance sheet? And we're going to see that in the D&O space on there. Again, we've had because of COVID, especially in the energy market space, we've had a slowdown in that. And so we start to see quite a bit of lawsuits start to come in as I focus on this personal lines in the employment practices space, especially under wage and hour type claims on, hey, I got laid off, attorneys attack that, and we start to see claims of how are you paid? Were you paid properly? Or did you follow all of the rules that you have to follow in there? And so this starts to drive up the cost and has been driving up the cost over the last year. So this part of one of the reasons, again, why you're seeing the trend. Again, this just talks a little bit about property, because property is one of the big things out there, and property means your equipment as well. So if you're an energy construction company and you have a lot of equipment, but maybe not a lot of building, but you do, have a lot of equipment space. Based on cat losses and non-cat losses, rate predictions, you can see here anywhere from 5 to maybe even over 30% rate increases. We're seeing capacity really shrink. We're tougher and tougher, harder to find coverages for people, harder to get terms the way that you used to be able to. Not as easy just to go to 7, 8, 9, 10 different players in the market space because they're all having to drive rate or moving out of the space. I will tell you, with the last 2 hurricanes kind of going right through the Gulf, we're going to continue to see on the energy market space, because that's where a bunch of that property that's offshore. And again, I realize it may not be, hey, I don't do anything either offshore. I don't do anything that has to do with all that, but your carriers do. And your carriers play into different pieces, even if maybe they don't write, maybe your carrier doesn't write anything involved in that. They have other companies that do write or are involved in that business, or may have layers in that business, that then just the trickle down effect ends up happening where everybody starts to feel the rate pinch overall. Maybe higher in other sectors, maybe higher in that sector, but you start to feel it on your end in your business insurance in there. On the energy, again, I kind of alluded to this a little bit here of what's happening. Again, energy in the space here, in the insurance space, we're really seeing less and less capacity and the pricing increasing. Auto's gone up. Auto, you're seeing 15, 20, 30% increases in autos. We're starting to see exclusions that have never been thrown on there before, some of them having to do with the pandemic. And so you have to be very careful of who you're using for a coverage, what type of exclusions being thrown on there, because you may start to be in violation of MSAs that you have, contracts that you have. That goes into the same effect in construction or other spaces, because insurance companies, as you go through your renewal, are starting to take the pandemic in, and they're starting to put additional exclusions on there. And so it's becoming a marketplace that we have not seen in over probably 20 years. 9/11 was really the last time the insurance marketplace had hardening, and that was short-lived for a while. It didn't go on for very long. It was, give or take, about 6 to 12 months where you had some pricing really harden in there, but it wasn't for very long. These trends seem to appear like they're probably going to be around, and you're going to have to be prepared as a business that you're going to see these trends happen for a while. I believe at least over the next, through 2021, maybe into 2022 at this point in time, depending on, again, how long we continue to go in the shutdown. You're probably seeing it today. I would think most of you all, if you're running a business on the banking side, and how tight they're getting on the banks and what they'll lend, how much they'll lend out. They want to see, improve up better and better EBITDA or profitability, depending on your situation, to be able to loan money. that trickles over to the insurance side as well, as to, again, the tightening on that. And I mentioned I'd gotten an email, and I wish I could kind of share this, wish I was able to have this on this slide here, because it'll show you kind of what I'm talking about. Another reason as to why insurance, I think you see it, you guys see those commercials out there for all the different lawyers and what they're, Thomas J. or the Hammer out of Houston, or if you're in San Antonio, the Fours, and they start putting out their verdicts. Well, the top 12 verdicts in 18 and in 19 in dollar values, they start from 5.9 billion, and number 10 is 116 million. Those are just the top 10 verdicts that insurance companies have paid out over the last couple of years or come down. Juries are awarding larger and larger verdicts that are out there. And that's what you're seeing with this. And so that then drives unprofitableness for the insurance carrier, which then you then in turn and see in your pricing on your business. Again, whether or not you had the loss or not had a loss. At this point, I kind of wanted to stop before I go into, well, what can you do about it, and see if there may be any questions or interactions on that piece of what's happening in the marketplace.
Looking at questions, I don't have any specific ones in the chat on that. If anyone wants to unmute, I think you can. But one thing I thought was interesting was, for example, when you bring up the fires, how it affects our premiums here, even if it has nothing to do with us or our industry or anything like that. And so is there any way, I guess for location, are there providers that are more local where they're not as affected by that, or is that pretty much just is what it is?
On the commercial side, there's less and less. So there are kind of three different levels when you look at it. You've got the large national companies that play in all the states, and then they usually have different companies that are globally that play all across the space. Then you have super regional companies that maybe aren't nationwide, aren't in every state. Then you have more regional companies that may be in just a handful of states or are just local. Problem is, usually those local companies, they're tougher in a sense of, as tight markets tighten, they don't have the breadth and the spread of risk to try to help out. So we're starting to see those companies having to raise their rates even greater. Your national companies have a spread of risk that kind of plays out across the space that helps with that if you fit into their program and their profile. And the super regionals kind of have that as well. Many times they're able to stay out of particular states, or they choose to stay out of particular states. However, the problem with the wildfire question is a lot of people play in California. And so most of your carriers play in California because it's a big state, just like Texas is. So there's a lot of, not all of them, but a good percentage of them play in California. And then when you go and you start to focus in on certain types of industries, again, in the energy space, it's a limited capacity to begin with of markets. The construction side has more people for sure, but then again, you have to be careful of the types of companies you're using based on coverages and exclusions there. So it does become where there are potential, and working with a good broker that has a variety of different carriers allows you to be able to go out there and kind of look to see if maybe some of those might be better for you. So somebody had maybe a question, I'm not sure.
Yeah, there was a question about kind of rental insurance policies. So if you're a real estate investor and you have rental properties, are you seeing the same trends basically, and would that apply to that industry as well? Because of property values are increasing and things like that. I'm assuming the answer would be yes, but.
Absolutely. Property as a whole, whether it's commercial property, residential property, that marketplace is tightening and going up. The habitational marketplace has really dwindled over the last 18 months, and how many carriers and how much capacity will they take on, and what kind of deductibles that you're looking at. So yes, the residential insurance policy rentals is in the same boat as commercial insurance. All these companies, it all is all fact. So you've got some weather related that's going on, with a lot of weather related that's happening with property. So not only are you talking about wildfires, and it's unfortunate it's hitting, I mean, it's hitting a state with very high end, very expensive property, these continual wildfires. So, I mean, it's $1 billion of losses over the last 3 years. And a lot of that's in residential property and in markets that insure that business over in California. Here in Texas, we continue to have an uptick of what they call microbursts. And so they're seeing these microbursts come out of the sky. It happened in Fort Worth area about a year ago, damages, and you're seeing more hail in areas in which it was. And again, your costs on your houses, your roofs and everything are way more expensive than they used to be. So costs being up of construction, then continued weather events is causing for that property market, whether it's commercial or residential, to really increase and tighten.
One thing, just a general comment, but I also think like the litigation environment is driving things up a lot.
Right. That's why I was mentioning this top 100 verdicts that I wish I could have. I saw it 10 minutes before it started, and I was reading through it. And as you read through the article, it's about 32 pages long. Probably half of that are auto-related accidents that are 20, 30, 40, 50, 60 plus $1 million verdicts. So that not only hits your auto insurance, that hits your umbrella carrier. Then that actually goes into, because many companies aren't carrying $70 million worth of insurance limits. So it's above their insurance limit that they have. And so that's some sort of bankruptcy that client's having to probably go into and sell off assets to pay off that verdict. And so, yes, these verdicts are, over the last 4 or 5 years, have gone through the roof on where juries are awarding defendants or the plaintiffs on this. And so it's definitely, that is a big piece of what's happening across the nation. And I don't see that changing anytime soon without some sort of legislative act to lower what juries can award on those things.
So a couple of things I'd like to spend some time on is, first, maybe if somebody is kind of reviewing their overall insurance coverage for their business, is like, what should they be looking at? What's a good process just as far as sort of reassessing what they need, seeing if there's opportunity for cost improvements. And then next, I'd like to talk specifically a little bit about like vehicle coverage, because that seems to be a pain point for a lot of people, is just who needs coverage, how much coverage you should get, things like that. Obviously, I know every situation's a little bit different, but we've seen just the vehicle coverage for a lot of the businesses that have guys in the field, so construction, energy, the insurance cost specifically related to vehicles is just sky high. And so can you maybe hit on those two things?
I can. So I'm going to write that down, Shannon, those two, vehicle and what you should do. So let me talk a little bit about I got 2 other slides, and I'll kind of hit those, but I think they'll sort of circle around and talk about
Perfect.
what can you do.
Thank you.
Here we go. So let me write that down real quick. Okay. So what can you do to control your insurance costs? Well, the historic model has been, and it's still used a lot, and I'll be completely open. My father used to own an insurance agency, so I unfortunately, I guess I fell into this business, great business, but fell into it at some point in time. But what can you do to control your costs? A lot of things that people come out and say, well, we can increase deductibles. Or maybe we can remove some coverages, or I want to limit my coverage. I want to slow that down. Well, obviously, yes, by removing some coverages, you're going to look to save some dollars. Increasing deductibles, I'm going to tell you from my client standpoint what I'm seeing in the space. So there is more data being used in every part of everybody's business now than ever. Insurance companies are no different. They are now using and have been using models that show how much probable maximum loss that they have on property, what type of rate that they should be getting in what city for autos, what they need for this. Increasing deductibles is no longer getting companies the return on their investment that it used to get with underwriters. Underwriters and carriers used to be able to say, sure, you have $1,000 auto deductible, you want to go up to $5,000, I'll give you a significant break on your pricing because you're taking more of that risk.
Well, which kind of makes sense though, because now if you're going to get sued for 50 million or something crazy, it doesn't really matter to the insurance company if you're paying a higher deductible or not. It's like a drop in the bucket.
It's a drop in the bucket. Our vehicles are way more expensive than they used to be. Who knew you'd be buying a Ford pickup truck for $50,000, $60,000, $70,000? I mean, that's base price on, you know, a Ford F-150 nowadays. And how many construction or oil field trucks are out there because we put all these new gadgets on, they have cameras, they have videos, and these vehicles are, so the repair on the vehicle is 10 grand. What does my $5,000 deductible? So I am not seeing, it doesn't hurt when you can take that as a company and you can do that. It definitely, if you can, but I'm not seeing, and my clients aren't seeing the return on, hey, if I move my deductible, and I will give you an example of one I've just recently, we're working through with a client of mine right now. They own a gas processing facility out in Colorado, and we're working on, they have $200 million worth of property that they have at the site, at the facility. We're working on trying to get them a $20 million limit of insurance on that $200 million. I'm working directly in London for this with this client. The client's willing to take up to $1 million deductible. My quote on a $250,000 deductible for them versus the $1 million deductible, the pricing decrease on that was $60,000. That's all the insurance carrier, because the insurance carrier has modeled it and they've said, well, we know we're going to lose X amount of dollars. So we want a price of X at this point in time. Doesn't matter your deductible. You want to move up? Sure, we'll give you. So for $750,000 more in risk that my client would take on, it only saves $60,000 in insurance premium. In my opinion, that's not a mathematical, that doesn't work out mathematically. You know, it should have been, and it had been in past, a more significant decrease for them. They would see some savings. So these types of things, although yes, can help, they aren't giving you the bang for the buck and what you're looking for on your insurance dollars any longer. So what can you do? What is working? What is working for my clients and the clients that I work with, and what we try to help them if we come on board and they're new clients with us, is really them taking a look at their total cost of risk. We define at T-Core Alliant total cost of risk of your insurance costs, retained losses, internal risk control expense, external risk control expense, and indirect costs. So obviously we all know insurance costs. That's your premiums you're paying there. You know, your retained losses, that is either losses that are on your loss runs, the losses that you're actually having, and or losses that you're retaining as a company that you may incur but not report into. Some of y'all in the energy space may have to keep your mod under a 1, and so you may not be returning every workers' comp claim in. You may be reporting it, but you may be paying it. But you're still paying that cost. That's still a cost to your business, whether or not it's reflected on your insurance carrier's loss runs. Internal risk control expense, again, that is internal staff or PPP that you're handling, whether or not you have HR, safety on site, any expense that you associate with risk control, with sort of controlling your risk as a whole. If that's the person that asked about residential, if that's the upkeep and maintenance on your residential, making sure and having inspections done when you have to have it, making sure that all of your fire extinguisher or carbon monoxide are up and running so that you don't have a loss to your property that then in turn causes you some sort of liability claim because of not having there. External risk control cost expense are third parties, whether that, again, safety, outsourced HR, maybe outsourced models that you're using to help you come in and control different types of risk there. And then, of course, indirect costs, that's really hard to come up with unless you really track when you have a loss and you track your time during that time frame of what that costs you and your team. But that is an expense that shows up on your balance sheet, a time that is taken away from the business that you do and the effort that you have to focus on. Even if it's a loss that is handled by your insurance carrier, it still takes time away from the business that you're trying to handle. That auto claim, that accident, having to get that vehicle, maybe a new vehicle, the time with the shop, how much time back and forth your company had to go back and forth to deal with the shop, have those calls, all that time away for that. What we're seeing is the clients that are taking this and taking a look at their internal cost and working with either internally, if they have that with HR and safety or a risk management insight, or it's external and looking at outside sources to help them build those types of controls and following through and creating that culture. We're seeing that those companies in this marketplace are able to control their insurance costs because they know what they're spending. They are minimizing and mitigating their risk where they can. And then they're able to work with their insurance broker to help them tell the story about what they are doing to help the insurance underwriter give them a better rate, help them with their insurance costs. Instead of looking at their insurance as a maintenance policy of every time something happens, here's all of the things that ABC company is doing better from a safety, from an HR procedures policy in place, from a PPE, from a training of our clients, from a training of our staff, our hiring processes, our NVRs, what we do, and how we look at that, how we manage if we have subcontractors, how we manage that and have a good solid contract in place, and how we manage their certificates of insurance to make sure we are doing everything internally. That allows me, if I'm working with you, my clients, for me to go back and tell that story and work with the underwriter to talk to them about why this risk is better for them and will perform better for them and get better pricing, get better terms than ABC company down the street of your competitor.
So when you're talking about so safety policies, for example, makes a ton of sense. Your safety policies, all your policies and procedures related to contractors. One thing that you mentioned, just to clarify, is partially if you're hiring a subcontractor, for example, and you're not requiring them to have their own coverage, or you're not verifying that they have their own coverage, it's opening your business up to more risk there. So what Chad is saying is basically the tighter all those policies are, it helps provide some comfort to the underwriter that you're basically more insurable than others. Is that layman's terms?
Absolutely. The more you have those in place and are following them. So what we run across is many companies, okay, we did this, but then we don't follow it. For the subcontractor, for example, well, we have a subcontract agreement, but we had this little work. It was $10,000 worth of work. We just hired this person. I can't tell you how many $10,000 worth of work that I've had big losses on. Like, hey, well, we didn't have it. Wait, they didn't have insurance. We didn't want to get it. It needed to be done immediately. We just skipped all of our processes that we normally do. We just had to get this work done real quick for the client. And I get it. Trust me. I have the same pressures of my clients call me. I got to get this thing done for them. I want to, my team pushes back on me because I say, hey, I want to, don't just get this done. With Chad, we have to go do it, get it done for the client, but those type of things. So having those policies and contracts in place, and having and making sure that certificates of insurance, so it stays off of your insurance, and we can push that liability down to the person that actually did the work and had the problem. If not, you are accepting their work and their liability on your insurance. And depending on your insurance policy, that may be excluded. That may have a 3 to 4 times the deductible. And you may not, depending on if you were told that at your insurance renewal, you may not know that your deductible on that loss is not a $5,000 deductible. It could be a $50,000 deductible. And you've got to come up with that money on the loss, or you may just be covering it out of pocket because the loss isn't over 50,000. So absolutely, those are the types of things in your business that allows you, especially in these bad times, but in the good times, it continues to help. And it was helping our clients lower their costs significantly, even in those times, and control that. Now in these tougher, hardening markets, those types of policies across the board, whether it's in your auto, whether it's in your contracts and how you manage that, good HR policies, hiring processes, training processes, those types of things are what the insurance carriers are looking for to be able to get you to the better carriers with the better pricing and keep your cost down. I'm not going to tell you that you're going to save money in this marketplace. Unfortunately, it's probably not, but I've had several renewals where we've been pretty close to flat on rate, which in this market at this point in time, that's a big win today, keeping the rate about flat from the previous year.
Do you have like a list of sort of those risk mitigation things that people can be focusing on? I mean, I'm sure their insurance provider should also have some feedback on this. But like, are there kind of key things that you see over and over again that are the main things people should be focusing on, other than what we've already talked about?
So again, having a good contract in place for any vendors that work for you, especially if you're in the construction. But if you've got vendors and they're doing work for you, the person that asked about the residential homes, if you have people coming in to do work for you, you should have a contract in place and get their certificates. So having a good contract in place and that has the right indemnification and the right information on insurance, having those two in place. Having a good fleet safety policy, and that includes cell phone policies, that includes training, MVR running, and having a process of running MVRs for all drivers at all times, and having a maintenance policy for corporate owned vehicles as well. Those are key. And then having a good HR policy, because again, I mentioned to it earlier, especially when downturns happen in the economy and people get laid off, that is when we start to see quite a few lawsuits regarding how I was paid, why I was let go. I was wrongfully terminated for this reason because I'm, whatever that category is. And if you don't have good policies and procedures in place from an HR perspective, that you walk down and you did the right things, there's a lot of loopholes and tricks and Department of Labor and EEOC. I mean, there is a ton of things that change every single day on, well, what was I supposed to do during this time frame? COVID has put together, I don't know how many different rules on when can people stay home, when can they not stay home, and following all those aspects. And then again, on top of that, people's businesses are going down, so they may have layoffs, they may have furloughs, and having to deal and doing those things in a proper manner really keeps you at least in a defensible position as a business owner, as a CFO, HR person, to be able to say, we followed all of these steps, we're in a good position if there is a lawsuit against your company. And we see those start to really uptick during recession times, unfortunately. I don't have a specific list, but
No,
I'm
those
not
are
sure
all
I
good
could put
ideas.
together.
They're good ideas. And
Yeah.
I think too, like, when you fill out your insurance coverage, we actually use that sometimes as a checklist in a way, because it's like, are you doing these things? Cybersecurity, for example, our insurance coverage has a list like for IT best practices. And so I think sometimes you can leverage your insurance application. Those questions are asking just to make sure that you have all that in place.
Yeah, I mean, I don't have just a specific list of it. What we do is we go through a risk identification with our clients. And so we spend some time with our clients on an initial meeting, talking to them about understanding their business, getting to know what they do, how they do stuff, what they have in place today, and identifying those risks that are there. But then we continue that process throughout the entire time of working with them, because that's not a one-time deal. And I realize, especially in this marketplace, I have customers that are trying to get into they're trying to move into different avenues to continue to stay alive and make money. And so what does that challenge bring? Does that do something different than what they were doing today from a liability or a risk standpoint? And do we have to talk about, that piece and what we can do for them there? And so we go through that and go through our risk identification process. And that becomes an ongoing conversation throughout the entire year that we're working with the client, different times during the year, having check-ins, following up of what's happening, what's going on with the business to make sure we're up to date, things that are changed. Obviously, as everybody started going home, for most of my clients, most of them do buy cyber, but it was a conversation of, hey, you're going to have a whole lot more of this over the internet. If you aren't buying it today, what are you continuing to do to protect yourself and protect the information that's going to be shared via Zoom, via however, or transacting business more remotely, maybe more wires, maybe wiring money, and making sure that those things are in place so that fraud isn't happening and you're not having a loss in your business that's not covered by your insurance.
Awesome.
So I can touch on, unless there's some other question, I can touch on your vehicle question if you want me to.
That'd be awesome. That seems to be a pain point for a lot of people. And then also I'd like to get your feedback. Like, for example, we're professional services. It's hard to know like when you should have vehicle coverage or not. Like, cause even for us, like people don't really drive much, but like once in a while they might be driving to a client. So I know other people have that scenario, but looking to it, most of the people that are on from our clients have like fleets of like multiple vehicles in the field and things like that. So you can probably focus most of your attention there.
Sure. So with fleet vehicles, so from just a pure insurance standpoint on your vehicle and your company trucks, it's really, I would want to talk it from a best practices of having and running MVRs for any driver that's going to be behind the wheel. So if you're not doing that, at least on an annual basis, and running those MVRs, and then having a policy within your fleet and HR manual that states your drivers, because it's not their vehicle, it's your vehicle as the company owner, that any type of accident, ticket, it could be your vehicle, it could be both, could definitely be both.
Question. Yes. I don't know if everybody knows what MVRs are. I'm sure
sorry.
Some people do, but some people might not know what you're talking about. So would you mind clarifying that?
Motor vehicle record, everybody's motor vehicle record. Apologize. Your motor vehicle. So the driving record of people that you're putting behind the wheel of your vehicles. And so making sure that you're doing that in a pre-hire scenario and then at least annually. So The old adage had been, well, doesn't my insurance carrier do that? Absolutely, they do before they insure you at every renewal. They run those. However, what they're looking at today is, why aren't you, for the cost and the availability to be able to run that, why aren't you also as a business owner running that at least periodically, at least once a year on your drivers to make sure that during that year, they haven't had 10 speeding tickets and then you're asking us to insure them, or they didn't get a DWI and didn't tell you about it and you've left them behind the wheel all year long for that. And so that's a risk mitigation that the insurance carrier wants to see, that you also don't want to be on the stand with a jury, with a lawyer across it going, hey, for $14, why didn't you run this motor vehicle record to know that your driver had 15 excessive speeding tickets just in the last year? I didn't, that's not a position you want to be in. So from that aspect, definitely you want to be doing that in your program. For your vehicle cost and insuring of your vehicle, it's a little misleading. What I get a lot of questions are, well, this original cost for this truck says $60,000, but we've been running it. It's not worth $60,000 any longer. Understand that. The carriers understand that. There's a formula behind there that the carriers depreciate that value. They know you're not going to get $60,000 for a 2015 F-350 that's been running in the oil field and has 250,000 miles on it. Probably hasn't been washed but once when you got it off the dealership maybe, and is pretty much ruined on the inside. You can look at that and lower that value. Again, I'm not seeing really much in the way of that's going to. What I look at and talk to my clients is when does it make sense on their vehicle coverage, especially in the marketplace today, of do we need to carry the physical damage any longer? If you don't have a loan on it and the bank's not requiring it, and you can fiscally manage through or fix most of your non-totaling of the vehicle, but many of the trucks that my clients again use out, especially energy and construction on the service side, those vehicles within a couple of years, the worth that they could go get for a vehicle today, can get a same type of vehicle, isn't maybe worth continuing the coverage on the physical damage. A couple of the other things you can look at, especially if you're carrying, if you're comfortable with the coverages, your uninsured and underinsured motorists on your liability coverage. So that coverage is essentially the same as your collision coverage on the physical damage portion of your auto policy. So if you're comfortable in the fact that if you get hit and into an accident and another car doesn't either have enough insurance or has no insurance, that you're willing to fix your own vehicle. Not if somebody got hurt, but you're just willing to fix your own vehicle as a company and get it repaired, get it fixed back on the market instead of making the claim there. That is another avenue you could look at to save dollars in that space. Another place you can look at if you carry workers' comp is under the either personal injury protection, they call it PIP, or med pay, which is just a no at fault. Again, that's not a big savings. Most people have it at a minimum. It's usually maybe $250 or less on your liability portion of your auto, but it's definitely something there that you could, because your driver or anybody in your vehicle that works for you, if you're carrying workers' comp, has workers' comp coverage. It would just be if there was a third party person that happened to be in the vehicle that the insurance carrier can pay out somewhere between $2,500, $5,000, $10,000 to say, hey, please don't sue us. Here's some medical bill money. That's essentially what that coverage is for. Those are some avenues where you can look at your auto insurance to potentially reduce that cost. Does that help? Does anybody have a specific question on their auto?
Not on auto. I think that was really helpful. One thing I was kind of making notes of was we run into for workman's comp when you're talking about that was when you do like your employee review and figuring out kind of what bucket, what employee goes in and their job descriptions. We had a client one time that hadn't reviewed that in a really long time. And so they actually were overpaying. It was pretty significant, like $20,000 a year or so, because the employees were not kind of identified appropriately. Can you maybe talk through that process and how it works? Because I'm sure that applies to several people here.
But before, do you want me to answer your professional service question on when you should have auto? Sorry.
Yes, real quick. Yeah, hit that one first.
That one real quick. Sorry, no problem. So for professional service, like when should you have? So if you don't own company autos, you can be covered from a company standpoint on your general liability through non-owned auto coverage, and you should at minimum have that. If you primarily use your vehicles as an executive officer or so for a company. This is for any company. You primarily use it for work and not as much. I recommend a lot of times, and sometimes people buy it in their name instead of the company name, or, you know, hey, why don't you go ahead and put in a lease just like you would lease it from a dealership, and say the company's responsible for all of the insurance and the company pays me and I put in. But if it's just a personal vehicle, whether it is an employee's or an owner, and it's not company owned, the non-owned portion you should have hired and non-owned auto in your liability, your general liability.
Okay.
That will cover the risk if for some reason you're brought into the suit. Now, the personal auto actually pays first, then the business
Okay.
auto would be excess to that. If you are a professional service or a business services that ask their employees to drive their vehicles on a regular basis, you should then require your people that are driving on a regular basis for you their own vehicles to increase their auto insurance from the minimum insurance. If we're all in Texas, I think minimum, I don't do personal lines, but I think it's $25.50 is the limit for minimum. I could be wrong on that, but you should at least have them bump it up to $100, $300. You might be, some carriers will give you up to $500,000. And if you can get them, that is protection for the business. Because again, that insurance, if you just have the minimum of insurance limits and they're driving for you on a regular basis, it's not going to be enough to protect you. So hopefully that answers.
No, that's great feedback. Like we don't actually have a process right now where we verify people's insurance coverage for their vehicles, because they don't really drive that often. But the fact of the matter is they do drive sometimes, and so that's probably something we should be looking at.
Definitely, if you have people on a regular basis driving for you, even if that's down to the post office for something, or down, you know, on a regular basis, you should be asking them to make sure, hey, send us a copy of your auto insurance. We need to make sure you have in place. Oh, and we require this limit from there.
Awesome.
So,
thank you.
On that end. So to your workers' comp question in codes, there you definitely want to make sure, and again, this is you know, another one of those risk identification things that goes on, is to sit down and look at where you're putting people in what codes. So for right now in this space, for a lot of oil field companies, they have a lot of downtime, right? On the service companies especially. You can within there, and if you don't have that code, you really need to look at, there's a permanent yard code that where your guys may 2 days a week, they're out in the field working, 3 days a week, they're around the shop, making sure this is going, doing maintenance, mowing the yard, whatever that might be, and you're paying them and keeping them busy there. Well, that permanent yard code versus the 6216 lease code, the standard oil field lease code, you're talking about less than $1 rate versus probably, you know, minimum $6 to $12 rate, depending on the company, on that 6216. So that's a huge savings in comp pay, and you can split that time. Construction companies can also split their time, but you have to be able to show that in your payroll to the auditor. But this is definitely a time where you should look at your codes. If you don't do that on a regular basis with your agent, and making sure that, hey, what are we doing? Where are we putting people in their codes? Who are they? And what payroll is getting associated to that code? Because yes, it can make a significant difference on the workers' comp depending on what jobs those people have. Now, which I know most companies have people that kind of split their time between codes. Again, in the construction and energy space in Texas, you can absolutely, if you can track it, you can show, hey, these hours, my employee did X, and that may be the higher code. For these hours, they worked here under X code in a much lower code. You just got to be able to prove that up on your payroll, but that can happen, and that is available, and something auditors won't necessarily just help you out with that. They're going to push you to, when I say auditors, the workers' comp auditors, they're going to push you to the higher code. They just want to lump it into the higher code and have you pay. So we've fought many times to show, no, we can show it on the payroll, but that's the big piece. What you have to be able to do as an employer is to be able to show through your payroll the different times and where they worked.
And can you look at that like frequently, like, so when COVID first happens, can you say we're going to go through all our codes and adjust it now, and then once our labor force is back in the field more, then we'll readjust at that point?
It can happen. It can happen all the time.
Whenever, right? Ongoing.
Yeah,
okay.
Absolutely.
I do actually think that might be an opportunity for some people, because I think we have a lot more people like you said, shop time or yard time or in the office, working from home, people that maybe were higher risk before. And so that's probably an opportunity for some, for sure.
And if they're with Texas Mutual, if you happen to be with Texas Mutual right now, Texas Mutual is also, I don't have the details off the top of my head, but I've looked at it numerous times. I don't know why I can't remember, but they have also had just Texas Mutual has had hey, if you've had to send people home working and they were maybe classed in a specific code, but now they're mostly working from home. Let's say perhaps, your sales force or something like that used to be on the road. They may be able to be taken into more of an Office 8810 code, which even though the sales force isn't a super high code, but that 8810 is even generally less. You may have some supervisors from a company that, hey, look, most of my time is now spent just on Zoom managing my guys out in the field type, and I've got some companies that's where that's happened. Okay, Texas Mutual has come out and said, okay, great. Plus, you've had people who have had to take time off and you've still had to pay them based on the Federal CARES Act program. Texas Mutual has come out and said they aren't going to charge. I believe they aren't going to charge for that payroll. So that's something to make sure you've looked at and gotten information from your broker if you haven't yet. I saw somebody might have had a question there, or had a comment.
I put Chad's contact information in the chat. If anybody has like a follow-up question, his name and email are there. Oh, good. Yep, right there. So if you have any additional questions, please feel free to reach out. Want to be sensitive to everyone's time, so we're most times almost up. But does anyone have any questions or anything they'd like to cover before we go about our day? Awesome. Well, thank you, Chad, for your time. We really appreciate you joining us today. It was very informative, and I learned a lot. So thank you.
Absolutely. Yeah, no, I appreciate everybody's time. Thanks for joining.
Wonderful. Y'all have a wonderful afternoon. Thank you.
Thank you, Shannon. Thank you, Chad. Bye.
Thank you.